Oh my goodness. Shift Technologies continues to get pummeled, and it feels like there's no floor for this company. Well, at least there's floor plan financing. Oh, that's not a funny joke. So in this video, I'm going to give my thoughts on Shift's current share price as well as the recent news that has come out, and I'm going to share my thoughts as to whether or not I think this company is still a buy, even though this company has dropped under $2 a share. So like I said, Shift's share price is horrific to look at. Now granted, most stocks have been down over the past month, but Shift has been downtrending for over a year now. So it brings up the question whether or not Shift Technologies is truly a buy. And I get it, this has not been a pretty year whatsoever if you've been invested in this company. But we need to be able to silence the noise and go back to what we know. First, the company is expected to do $620 million in revenue for 2021, while their market cap right now is somewhere around $170 million. Yes, you heard me correctly. This company has a 2021 price to sales ratio of almost 0.25. So the company is valued at a quarter of their annual revenue. Now let's for right now put Shift aside. If there was any company that had a price to sales ratio of 0.25, you would either think this company is significantly undervalued or the company is on the edge of bankruptcy. And that is it. So the question has to be for anyone invested in this company or are thinking of investing in this company is, do you believe this company is going to go bankrupt in the next 3 to 5 years? I think that there are a lot of people that are looking at this company and they've seen the downtrend and they're like,
well, I don't want to lose any more money.
And then they go ahead and sell. Second, the company has improved guidance 3 times over the past year in revenues and gross profits per unit. So no one can tell me that this company has improved guidance and yet is still supposed to be priced for bankruptcy. In the past year, Shift has increased their gross profits per unit by over 50%. That is insanity. And when Carvana had similar revenues as Shift, they had half the gross profits per unit that Shift does now. Granted, with the increased prices of used cars, it makes it easier to improve on gross profits. But the company is expected to continue to grow on gross profits over the next few years. Third, the customer acquisition costs have decreased substantially over the last year, and that's going to lead to better margins. The beautiful thing about this is this isn't only year over year, but also quarter over quarter. From Q1 of 21 to Q3 of 2021, their customer acquisition costs were cut in half. What this tells me is that the new marketing strategy that they've implemented has been working extremely well, and we've already seen significant improvements in the near term. Fourth, the company has more cash than they do their entire market cap. Now bears are going to say,
well, they're burning a lot of cash and they're only going to be able to last for like another year and a half.
But the problem with saying that is that you are assuming that gross profits are not going to improve and therefore their margins aren't going to improve either. And the other thing is you're assuming that the company's not going to be able to raise cash over the next couple of years. I'm confident that this company is going to continue to grow on gross profits. And with Jeff Clements as president of Shift, this company will be able to raise the funds that they need over the next few years. Now, with all that said, I do believe that the company is going to reduce their cash for Q4 because of the amount of hiring that they have coming up, as well as the improvements to their inventory. But with the floor plan financing, they will be able to sustain themselves as well as be able to use less cash than expected. And speaking of their floor plan financing, Ally Bank would not have given them that money if they did not expect them to be able to pay it off over the next few years. And at the time of the financing, Shift had a market cap of about $300 million. And the financing is for $100 million. So this is a really good sign for the company as well. Another thing to consider is as of Q3, the company had 3 times their current liabilities and current assets. Now, of course, their financing will add to their liabilities. But if we were to take their current assets and subtracted that from their current liabilities, including their financing, you would almost get their current market cap. Now, why does this matter? This means that the company is valued for what they are right now. The market is basically saying that this is going to be the best that they will ever be. They won't improve on their gross profits, they won't improve on their margins, and that means the big thing, they're not going to be profitable. But in my opinion, if you believe that this company is going to continue to grow in gross profits, margin, and become profitable, then I don't think there's anything to worry about. Now, another thing that I've seen from the comments down below, as well as on social media, is the compensation of the COO. There are several bears that are saying that Shift has to do this in order to keep him, and it's simply just too much money. But here's the thing. As some of you know, over the past month, I've done so much research on Palantir, and this company has focused on not only recruiting, but retaining the best employees possible in order to improve their overall products. And I think the same thing applies here for the COO. At the beginning of this year, the company was expected to do $450 million in revenue. And what are they projected to do now? $625 million. There are people talking about a $2 million deal for someone who is a part of this management team that has grown guidance $175 million over the last year. I personally think that's silly. But if you think that this is an issue, consider where they were at the beginning of this year and look at where they are now. The last thing that I want to talk about is the recent news on Shift hosting its first ever pop-up card to cash event in Los Angeles. When we look at the card to cash idea, I think this company could be able to get cards at a much cheaper price in an event like this because of how convenient the process would be. And this will also be a great way for them to improve on their inventory quickly. If this event is a success, then Shift will have the inventory that they need going into Q2. Now, honestly, I don't know how this is going to turn out. But I'm truly excited to see the results and hear the management team's explanation for this kind of event in their next conference call. Now, here are my thoughts as to what the market is saying about this company. First, the pricing, in my opinion, is absurd. And until I see evidence that Shift is not going to be able to improve on their margins, it doesn't make any sense for this company to be priced for bankruptcy. And so I believe the share price is not a reflection on the company's execution. From the time I've started investing in this company to where they are right now, the business and operations have improved drastically. And I believe the things that I've said previously prove it to be true. One other thing to consider is as the share price falls, the amount of risk falls with it. If I were to pay $10 for a share of Shift, there is greater risk that the stock would fall compared to where it is now at $2. And that is extremely important when it comes to buying this company right now. But here's what I will say. As bullish as I am on this company, I need to talk about where we are in 2022. If you haven't watched my video on the strategies I'm putting forth in 2022, I believe that the best gains are going to come from small growth companies that are expected to be profitable in the next year or are already profitable this year. Now, don't get me wrong, I believe Shift is going to have a good year. But these wild price targets that people are throwing out, I believe need to tone down. With the possibility of interest rates going up, investors will want to be in companies that will stay strong through these hikes. And that's why I truly believe that it's going to be the profitable companies that have already been beaten down over this last year. In terms of price target for the end of this year, I really think we need to get through the fear and uncertainty that has happened over these past couple of months in order to make a good price prediction. But do I think 3 to 5 years from now, this company could be valued at $30 a share? Without a doubt. So with all that said, what am I planning on doing with Shift? I'm buying because I believe this pricing makes absolutely no sense. But I am not buying for 2022. I'm buying Shift for 2023 to 2025. If this company remains under $250, I'm going to continue to buy. And while this company is under $2, I will be loading the boat. As I said in the beginning of this video, we need to ask ourselves the question if we believe that this company is going to go bankrupt in the next few years. And when we go back to the fundamentals of this company, I believe that it will allow us to think past the horrific downtrend that we've experienced over this past year and focus more on what truly matters, which is the growth and execution of this company. But I hope you guys enjoyed this video. If you don't mind, would you consider destroying that like button? It helps this channel immensely, as well as comment down below your thoughts on Shift's current share price. Would love to hear your thoughts on that. And if you're new here, hit that subscribe button down below. That way you are notified when new content comes out. Hope you guys enjoy the rest of your week, and we'll see you in the next one.